Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is Amazon. We'll discuss, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Well, if you may have heard that there are a couple of big cap companies that are going to be going through stock splits. This coming up week, we're going to see Amazon go through a 20-for-1 stock split. And then in July, we're going to see Alphabet go for a 20-for-1 stock split. I should say anticipated. It's not official until the board votes on both of the splits. They got to make it official. So it is anticipated that we're going to be going through a stock split this weekend in Amazon. And I want to highlight something before I get too far along, and we'll put this in the chat box. But inside our community, I actually wrote a little article that highlights the Google and Amazon stock split. Obvious, Google is Google is also referenced as Alphabet, but here is the stock split inside our Ally community hub, ally.com/do-it-right with dashes in it. And it talks about the important dates. So here I'm going to go down and highlight the dates, the record date of Amazon, which is May 27th. It doesn't necessarily matter when you buy the stock, and it's a little bit confusing. But if you bought it after that date, you're going to get the shares that's created by the stock split. The most important date in my mind is the June 3rd date. That is always on a weekend. Usually when they do a stock split, they allow all the bookkeeping to happen over the weekend, a non-business day. And then when you wake up on June 6th, the stock will be trading split adjusted. That means that the stock price will be divided by 20, and based off of where it finishes at on June 3rd, that's going to be the opening price on June 6th. And in your account, for every one share of Google, or on this instance, we're going to talk about Amazon, for every one share of Amazon that you may have in your account, you will receive another 19 shares for a total of 20 shares in the account. Now, always important to note that a stock split doesn't necessarily mean the stock is going up or it's going down. Stock splits do nothing to the valuation of the underlying stock. But Amazon, we titled today's event as Amazon is splitting like it's 1999. And the concept behind that is Amazon split twice in 1999 and once in 1998. So they were very busy splitting their stock. It was very soon after their IPO. And on the last split, which was September 2nd of 1999, the stock split, it landed, and I'm going to round off here a little bit, but after the split, it was right around 57, and approximately a month later was trading right around 77. So about a 35% rise in the stock over that month. Amazon did have strong moves from their splits, but then again, the stock eventually started to drop, and it took a while for it to establish itself again as a leader in the marketplace and eventually become one of the mega caps. All right, so those are some of the facts that are behind Amazon. So how would we trade that position today? Well, what would we look to do? And I'm going to build this as a fear of missing out trade. If we didn't have the 1999 title, we'd probably put FOMO in it, because the marketplace is a much different market than it was in 1999. We got a lot of people are trying to say recession, right? They're trying, they're not, but we're not quite there. We have low unemployment, but we have high inflation. We have interest rates increasing. We have a hawkish Fed that says we're looking at the next couple of meetings making a 50 basis point move. Right now, it's looking like it's going to stay in that range, but some people have even said that maybe the Fed should think about just doing a 1% interest rate or 100 basis points and just get it over with, right? And then we can move on with our lives and kind of know a little bit more with more certainty what's happening in the marketplace. So with that said, I'm going to run over to my VIX watch list, and let's just highlight a couple of things before we get into the trade today, because we're going to spend a lot of time on the trade because of the stock split. I'm going to give you some concerns that you want to think about if you're buying options around a stock split, around a stock that is splitting. Let's put it that way. All right, so here's my VIX watch list. The thing that I've noted, and I still, a lot of people are raising their hand saying that we may be in a recession, or that that there's a high probability that we're going to be in a recession. You can debate that all you want, but I'll tell you this: the VIX doesn't feel that way. If we look at the VIX, the volatility index, today it's trading right around 26%. That is fairly high volatility, but it isn't high since the pandemic days, right? It took forever for the marketplace, even while it was going up dramatically. The VIX, it took forever for the VIX to break below 20. Now we see the VIX trading right around 26% implied volatility. Still, considering the geopolitical concerns that we have, the interest rate factor, and we actually have the 10-year. Now, this is fairly good news, and it can be a hint that the Fed is not going to be quite as hawkish. When you see the 10-year, which was up above the 3% level, now be trading at 2.846. This is the TNX index, which is the interest rate index. If you want to see where the interest rate is on the 10-year, you just move the decimal over. So 2.846 is where the interest rate is on the 10-year as we speak. But note the VVIX. Now, we don't talk about the VVIX a lot because, to be blunt, it's usually not very interesting. But the VVIX is the VIX of the VIX. In other words, you're looking at the implied volatility of the options that trade within the VIX underlying when you type in the symbol VIX. And I have this chart up here, and I'm going to go all the way back to the downturn before the pandemic. And if you look at this, we're at a new low since then. So the premium in the VIX options, the call options, the put options, is at the lowest that it has been before the pandemic. Now, I don't know exactly what that means, but it means to me that people aren't buying, they're not buying puts, they're not buying call options in the VIX. They're not driving up that volatility, which you would kind of expect would be a place where people may be going to if they were concerned about the marketplace. Ideally, if you're in the SPX, you're going to be buying puts for protection. If you are in the VIX index, you have an inverse relationship, so you'd be buying call options. But there does not seem to be a lot of buying going on to see the actual VVIX at a new low since the pandemic. And so it's still, and I've used the term befuddling before, and it's still kind of crazy to me to see the VIX at these levels. As a matter of fact, the market has actually been more volatile than what the VIX has implied. The actual volatility has been higher over the last couple of weeks. And I don't know. The VIX definitely doesn't think a recession is in the works. Now, that's just one data point, but that's what I'm interpreting from looking at the VIX index. Okay, now, so we're going to look at the NASDAQ, and if we compare the NASDAQ to the SPX right now, we see that the NASDAQ is actually higher, and it's probably being driven by Amazon. Amazon's up 3.62%, probably because of the anticipated split. Not 100% sure of that. We do see the Russell 2000, that is down about 0.75%, and the SPX is down about 0.1% at this point in time. So the market's actually made a little bit of a rally. These two markets were down a little bit more, but the NASDAQ is leading the way, which is, overall a good thing because it was leading the market on the way down. So it'd be nice if we could get a little bounce back up in the NASDAQ. Okay, so Amazon, how would we play this? I'm not necessarily looked at Amazon because I want to get extremely bullish on Amazon because they're doing the split, right? It's more so that if you are trading splits, stock play of the day is all about trying to look inside the options playbook and talk about a strategy that you may use. And Amazon is an expensive stock, $2,384. So going through this split, it makes it more feasible to buy that nice round 100 share lot. Because if you look at it right now and you were to buy 100 shares, you're talking about 238,000 plus some change dollars to buy 100 shares of it. After the split, it makes it much more feasible to do it. And people anticipate that that's going to drive some demand because a lot of people like to have things nice and clean, that nice 100 round lot. And I don't blame them either. It helps in the options trading world. It makes it much easier to sell covered calls against the position, even buy protection, if you will. But on June 6th, the theory would be that if all the accounting and all the bookworks get done, that you would wake up on the 6th and all the back office stuff is done. And for every share of Amazon, you end up with 19. Sometimes it takes a little longer, might not be till the end of the day that you'll see it in the account. You can always sell the shares whenever you want. But ideally, on a big split like this, on one of the most widely held positions in the brokerage industry, there can be trials and tribulations trying to get all the bookwork done on the actual day of the split when the shares are trading post split, if you will. All right. So let's look at it. I would look at it a long call spread, and it's a little bit of the same reason. We talk about fear of missing out trades, and a lot of times we like to look at deep in the money options as a surrogate for the stock. They're just too expensive, and it's that simple. I don't know if I want to risk that much. So just like in Zoom that we talked about last week, we're going to do a long call spread. And how are we going to pick our strikes? What are we going to pick our expiration? So let's walk through that. All right. Amazon on the split, by the way, I want to highlight that this is a real interesting area for the stock. And I'm going all the way back to 2020. And interesting, just because for lack of a better way of saying it, but we had the breakout here at 2000, strong move to the upside. It looked like it was a real strong breakout. Then all of a sudden, boom, we're down back to the 2000 level, hung out there for a little bit, provided some support. Stock took out all the way down, came back up, and then boom, it took off. So we're trading right in this gap on Amazon. So I find that interesting. I wouldn't necessarily say that that's bullish or bearish, but I do like the two strong moves here above this line area right here. So 22, it's right around where the 20-day moving average actually is. It's when Amazon broke out through that, which is 22.36. Okay. So the chart is interesting area where the stock is at. Amazon right now up 79 on the day. We're going to look at a long call spread. So they're very expensive options. Let me jump back. I'm being a little bit jerky here, but I'm going to jump back to the chains. And you see that we're trading at about a 50% implied volatility. Okay, so that's fairly high for Amazon. It's probably because of the split. And if you look at it, we always want to look at the expected move when we're setting up a spread. In other words, the expiration we're going to pick is the June expiration, and it's a lot because they're expensive to go out further and further in time. It gets costly. You could go out and try to look at July if you'd like to. I don't mind that trade going out too far in time. But if you're really trying to trade the split, we've talked about this before, on long call spreads, you want to be correct on your forecast closer to the expiration date. So we're going to give 17 days for this to plan out. But now the concept also is that you got to be right in a hurry, and very obviously, because you only have 17 days for that type of movement. So this is going to be the expiration that we pick. And I'm going to highlight a couple more things just as we go through the strikes that we're picking. Stuff that you need to know when you're trading any stock that's splitting, let alone Amazon. Okay. So we're going to pick the 2400 strike. Now, there is some method to my madness. If I'm looking at the 2400 strike, when you're looking at the strike prices that you're picking, it's good to try to pick ones that aren't going to have a weird fraction in them. So you take the strike price, you take 2400 and you divide that by 20, and you come up with the strike price of 120. So after the split, this strike price, this anticipated split, the strike price should be 120 on your option contract. So this is the one that we're going to buy. We're going to look at the expected move which is, so we call it 73, okay, right here. So we're looking at about 200 points. Let's say we bought the call and we bought the put. We're talking about a 200-point expected move approximately. And we want to make sure that we're within that range. And with the stock right now at 23, we'll call it 23.75. So that would be 25.75. And we just want to make sure that the market thinks it can get to our short strike. So we're going to go down to the 28.40. And once again, if we do the math on it, we take 24.80, and we divide that by 20, we come up with 124. So if we do this spread as a paper trade, which we are going to be doing, we're going to end up with a 4-point wide spread. And for every one contract that we buy, we always look at a 1-by-1 spread here on the stock play of the day. You will end up with a 20-by-20 spread. And the spread will be from 120 to 124. It will be 4 points wide, as opposed to in this instance, we are 80 points wide. Total cost of the spread right now is $32.75. So it is expensive, even though we're going out of the money. It is expensive. And I don't mind lowering that if you want to go a little bit further out of the money. Just make sure that we stay within that expected move. And hopefully you get that type of pop that we're looking for on the upside that may be caused by a stock split. Okay. So 32.75, that would be our total risk on this trade. So 32.75 times 100 is the total cost, which is $3,275. So, we talked about buying a deep in the money option contract as a FOMO, a fear of missing out trade. Well, this is a spread that we're buying out of the money, and we're still going to risk $3,275 for every 1-by-1 spread that we do, plus commissions, of course. Want to add that into your scenario. And so it makes it really hard to just go out and try to buy a deeper in the money option contract. It would be very expensive. So this is part of the reason why we're doing this trade. So I'm going to make it the official paper trade by putting it in the right rail over here. And let me scroll down a little bit here, and I'll highlight. Here's our trade for this week. We're looking at buying to open, the June 17th, 2400 strike call. Selling to open, that June 17th, 2480 strike call. We're going to have to work this, and the market is very liquid. It's wide because it's more volatile than normal, but you have very active option contracts. So a bid point fill is feasible. It's never guaranteed, but it's feasible. So we'll go 32. Let's call it 32.50. Let's make it a nice round number. Okay. So $3,250 plus commission. That would be our total risk on this trade. And we are 80 points wide. So how do we figure out our upside? You take 80, the width between the strikes, minus 32.50, and we come up with 47.50. Now, combining that's going to get you to 80. So we're managing our risk in that we're risking less than what we can make. So we have limited and defined risk. And now remember, we're going to end up with 20 contracts of both the long option contract and the short option contract. And the price, if it's 32.50 and it hangs right there going into the split, which is next week, so 32.50, you take that and you divide that by 20. And that means that the price of the spread, if the stock were to stay here, which I'm sure it's not going to for a whole week, but it would be $1.63. So the spread goes from $3,250 to do a 1-by-1 spread to a 20-by-20 spread that is trading for $1.63 or $163. Now, if the stock doesn't move, the market value stays the same. And that's the goal of the split. We're not trying to add value or detract value. What you're just literally trying to do is lower the stock price, make it more feasible to be able to buy 100 shares and even cheaper option contracts. But in theory, if the stock didn't move, you'd have the exact same value, market value of your Amazon options or your Amazon stock pre-split and post-split. Okay. Now, A lot to talk about. I'm going to reference the article again. We'll make sure we'll probably throw it back in the chat box. If you have any questions about these splits, please put them in the chat box right now. I'm open to talk about it. And I'm sure when Alphabet goes through their split, we'll come back and we'll have a stock split of the day that will be focused on the Alphabet stock split. All right. So we always want to make this interactive. That's why we're here on the Ally YouTube channel, and we have that chat box open up so that we can have a lively conversation about things that are confusing, like the 20-for-1 stock split that's going on in Amazon. All right, so now I talked about these strikes, and I'm going to highlight something here. If you go to the OCC.com, that stands for the Options Clearing Corporation, you type in Amazon 20-for-1 split, you will see a PDF that will do the math for you on your strikes. And if you're deciding what strikes you want to do for your long call spread, it's fairly easy to go on in, click on it. It tells you a little bit of details about it as a PDF, and you scroll down and it tells you what the strike prices are going to be. So I'm going to scroll down to the 2400 strike, which is right here, and we see, yeah, I did the math right. So the 2400 strike divided by 20 is 120. So after the split, that you'll have a 120 strike call option, because we're looking on the call side. And then on the 2480 strike, here you go. Then you're going to end up with a 124 strike call option. So now I'm going to highlight a couple of strikes that I really wouldn't want to trade. The 2470, and it's not bad. It's 2350. 50 cents isn't too rough. But the 2475 is a 123 3/4 strike call option. Now, to draw your attention to that, Amazon is a very liquid underlying. But if new people are coming to the marketplace, do you think they're going to buy the 124 strike call option, or do you think they're going to look at the 123.75 strike call option? Right? They want to trade the more normal option contracts. So a lot of times when stocks go through splits, Amazon may be a little bit different because it's such a popular underlying, but most of the time you want to try to land on strikes that are on even numbers, and it makes it much easier. Well, I shouldn't say much easier. It can add some liquidity to the option contract that you're trading, because more people are going to be drawn to the not odd strikes. And so I always keep that in mind if I'm doing a spread, or I'm doing even just buying an option outright. I want to know what my strike is going to be after the split. So in our instance, we're going to come out with a 120 strike and a 124 strike. We shouldn't have a ton of concerns. It's just a little bit of a benefit to you. Bid-ask spreads can get wide in Amazon. They'll be a little bit tighter now that we have a lower price stock. So that's a good thing. And I would expect fairly decent volumes after the split in this underlying stock. All right, so covered everything that I wanted to get through today. If you have any questions, let me check the chat box out and we'll see where we are at. All right, looks like we have a couple in here. So 1 second, let me take a quick peek at that. All right, Badger says, I will miss the Friday overtime. All right, and thank you, Badger, appreciate that. I'm gonna miss it too. I do like the follow-up. So that Badger's highlighting the fact that we're not going to be doing the stock play of the day overtime on Fridays anymore. We're going to try to roll it in and just make it a once a week show. However, a follow up on the previous trade during the regular Tuesday episodes is almost as good. And I appreciate your presentation regardless of timing. Now, one of the things that will be true is the chat box will be opened up. So we're going to go through the trade and we're going to open up a can of worms by saying, hey, let's get more interactive with this. The overtime, we were trying to keep it down to a minimal time period. We didn't want to get too long in the tooth. So we didn't have the chat box open up. But on Tuesdays now, we're going to kind of commit to, we're going to try to keep it to 30 minutes, but you'll be able to ask questions about it. And then Dean, so we'd be hoping that the lower price, so Dean's got a question too. So here we go. So we'd be hoping that the lower price after the split drives up buying volumes and stock price rises, SP rises. Yep, That's it. That's all it is. It's no rationale as to why it would rise, why the stock would go up or even go down, because the valuation is the valuation. But in theory, the concept is that, well, after a split, maybe it's more feasible for people to buy 100 shares and they wait for it. And then that's when they come on in and buy. All right. Yeah, that would be just the way that we'd look at it. So any last call for questions? And don't forget about the article. It's already in the chat box. It's at ally.com/do it right with dashes in it. And that also covers the alphabet 20-for-1 split too. All right. All right, Charles. Not quite sure why that might be. I didn't have any problem. I was actually using the website right now. Charles says he can't log in. So I'm sure we'll get that taken care of. We'll leave it on that note. All right, everyone. Please ring the bell, click subscribe. I will be traveling next week, but I will be doing the stock play of the day from the road. So if you'd like to get all the alerts, please click subscribe, ring the bell, and we'll see you next Tuesday for the stock play of the day. Thanks for coming, everyone.